Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about retirement income and more importantly, taxes in retirement. So I will say this video is more geared towards couples because there is a bit more of a tax savings when it comes to couples versus individuals in retirement. And we actually see a lot of retired people either move in common law partner or get married in retirement for tax savings. So it sounds crazy. I'm not saying you should do that if you're single, but there's definitely some tax savings for couples over singles. And I think the government's trying to work hard on figuring out how to equalize that. They just haven't come to a good solution yet. But today we're going to talk about income taxes and why $100,000 income before retirement is very different than $100,000 income in retirement. And it's about a $12,000 net per year difference. So there's a big difference when you enter retirement. And that's why we tell our clients a lot of the time, when you retire, you don't need as much income. And a lot of people say, well, my bills are the same. But it's actually more on the tax side and how that income is driven out, the taxes you have to pay, and how it's all structured. So let's go through that. So as you know, in retirement, you can split income. So any retirement income, and we'll leave a link below in this video that talks about what type of income can be split, but the majority of retirement income, so your RSP and pension income and that kind of thing, can all be split with your spouse or common law partner. And again, that's why there's a bit of a benefit. If you're a single person, you have no one to split that income with. So the whole tax liability falls on yourself. So a bit of a disadvantage there. But let's look at being able to split income. Obviously in retirement, we can split that income. So what does that mean for amount of taxes that we have to actually pay? So let's quickly jump into an example, and probably a very common example that we run into with pre-retirees. And it's where, one spouse works full time and the other spouse has maybe retired, but maybe isn't working at all. So you have, $100,000 income with one spouse and zero income for the other spouse. And it's very common. We run into it all the time. So again, we try to explain the tax benefits of retirement and retirement income stream. So let's go through an actual example of that. So I just have TurboTax pulled up here, online tax calculator, and I want to run through the difference. So I'm running BC. Again, you can go here and choose the province that you live in. But so 100,000 of taxable income, while you're working. You're gonna owe $21,600 in taxes, okay? Plus on top of that, you're gonna have your CPP and EI premiums, okay, of $3,054 in BC, okay? So again, 100,000 of a family income, because we talked about earlier that, your income is 100,000 one spouse, zero the other spouse. So household income is $100,000. Taxes due, $21,620. Now, let's run into retirement income of $100,000 where we're able to split. So let's say you're pulling $100,000 out of your, maybe pension, RSP, whatever it is, but it's $100,000 that you can now split with your spouse. What does that look like? So when we jump into this example, you can see I've put in $50,000. So this would qualify as one of this spouse or common law partners. And again, total tax, $6,944. Well, that's much less than half of the $21,620. So if able to split the $100,000 of income, you're at $69. That's a total tax due of $13,888. Okay. Well, that's a big difference. Okay. So again, $100,000 of income, zero income, over $21,000 of tax. Now, when we even that out to 50-50, it's less than $14,000 of tax. So that's a big savings. Monthly, that's $958 every single month in net amount in your pocket, almost $12,000 every year. So almost $1,000 a month. That's crazy. So again, same amount of income coming into your household, completely different amount of tax that you're paying, okay? So when we're talking about retirement income, often as a financial planner, I tell my clients, you don't need as much income now in retirement as you did pre-retirement. And part of that is lifestyle. And we're going to go into that in a separate video here this week. But your lifestyle does change, and it especially changes over time. There's kind of three phases to retirement: the go-go stage, the slow-go, and then the no-go stage. So that we'll do in a different video. But as far as taxes due, again, if you have a family or household income of $100,000 and it's skewed, much higher for one spouse than the other, you're paying much more tax because the higher income earner falls into a higher marginal tax rate, which means that the next dollar that they earn, they're paying a much higher amount of tax on. And that's why when you enter retirement and you're able to equalize that income between two partners, two spouses, it really brings down that tax due. So again, on a $100,000 example, if you're able to split that income, you're saving almost $1,000 every single month. So what does that mean? So in retirement, you would each need to earn only $42,000 to have the same take-home pay as if you were $100,000 and zero. So again, if your income's $100,000 and zero pre-retirement, it would be the same as a total household income of $84,000 in retirement. So $16,000 of total income less needed to have the same amount of money in your pocket to spend on a daily, weekly, monthly, annual basis. So big differences. So look at the tax payable in retirement versus pre-retirement, because it's not apples to apples. Okay, so jump on TurboTax or any online tax calculator and run through your example and see how much less tax you're going to pay because you're able to income split. Again, I'm not jumping into the pension income tax credit in this video and other benefits that you get in retirement, some tax deductions and credits that you get. This is just purely our family has $100,000 income pre-retirement and post-retirement. What's the tax difference between the two? And as we've seen, it's about $12,000 a year. So it's substantial. So pay attention to this. If you haven't done tax planning for retirement, make sure to sit down. If you have the skills and knowledge yourself, do it yourself. Run your own numbers, see what that looks like. If you're not sure, meet with your accountant or financial planner and start working through these numbers to see how it's going to affect your retirement and maybe give you a better gauge on how much assets and income you're going to actually need in retirement. So again, when we look at tax planning in retirement for Canadians, make sure you look at the actual tax due on total income and if you're able to split that, because your tax bill is going to be much lower. Again, there's no CPP and OAS payment, so when you run these tax calculators online, make sure that you take off CPP and OAS because you're not paying into them anymore. You might even be taking money out of the CPP and OAS. So make sure you just look at taxes due, and because most calculators will include that CPP and OAS number. So run through your numbers, see if there's a big difference in retirement. If you have a household where there's a higher income earner and a lower income earner, there's going to be a big difference in retirement. So run through your numbers, see what it looks like, and see how much less income you need to generate the same amount of net money in your pocket to spend on a monthly basis. So thanks so much for joining us in this video. Again, we create these videos off of situations that we see on a daily basis with our clients, and we're just trying to get this information out to help you guys. So hopefully these videos help. If they do, make sure to hit the thumbs up. If you're not a subscriber to our channel, hit the subscribe button below. We release 2 to 3 videos every single week on financial, retirement, tax, and estate planning. So thanks for joining us today. We'll see you in the next video.